Welcome to section 3. We're going to finally get into the actual charts, look at charts, and look at the qualitative aspects of price action. In lecture 9 in particular, we're going to talk about how reading price is almost like reading emotions. So the reason why we want to dig deeper down into price action from a qualitative perspective is we're going to get a more intuitive understanding of how price moves in the markets if we can associate it with various emotions. If you just have a pure quantitative understanding, you might not actually understand the true drivers that are moving price, and you lose that type of intuition. So knowing the emotional signatures behind price movement can make the entire process more intuitive and make more sense. Now, charts are virtually a map of investors' actions and psychological states. So when we look at a chart and we see price action, we see rallies and capitulations and panics, we are seeing emotions play out real time. Pain points, capitulation levels, their fear, their greed, and all of these things reveal how opponents are positioning and attempting to shake each other out. There's literally a visual record of one trader to another. So in this gold example, we see a consolidation pattern here and then a breakdown. And instead of just, looking at the dry visual part of price here, we know that investors gold bulls are freaking out as this falls, because all of these people that have bought in this area since mid-2011 to this time where it broke down in early 2013 are now underwater. So you can imagine the psychology and emotions behind that. They've been sitting in a dead money trade for years. And if they've bought even down at a decent price level near support, they're now down money. So how are those investors feeling about their gold positions and how they are going to react going forward? That type of information is good analysis that can help us take better trades and determine what's going to happen going forward. Now, similar thing here with silver, where we see this huge rally up. So instead of just looking at this rally, we can think, what are silver investors thinking right now? How, are they extremely excited? Do they think that they can never lose? Was that going to lead to some sort of complacency down the line or a sharp reversal? So attaching that emotion to the price action allows us to better explain, what could happen going forward and, what's really driving this price. So it's not just a pure quantitative outlook at it. Now, the head and shoulders pattern, if we're going to apply this type of thinking, everyone really knows this pattern, but why does it work and what does it really mean? So going through the emotional exercises of why does this pattern show up, identify and explain why the head and shoulders pattern is so dominant in markets and shows up all the time. So the emotional narrative would go as follows, and we're going to look, the highlighted portion here is referring to the part that we're going to be talking about. So in this first leg up, there's generally low volatility. Everyone's believing in the trend. People are buying in more and more as FOMO reinforces the trend. And we typically get a buying climax right at this top point, which forms the first shoulder. Then what happens is FOMO gets exhausted for the time being. All of the buyers that had fear of missing out and were supporting the trend are not there anymore. So a sell-off starts to occur. And this is the largest sell-off in recent history of the trend. And it comes all the way back down to where the initial FOMO buyers started buying to, and investors are experiencing fear, pain for the first time. Then, since the momentum narrative is still alive and it hasn't been threatened enough, there's only been one test to test these people's confidence. Sideline investors see this initial shakeout as a buying opportunity, so they bid it hard, and FOMO people jump back on board, and the thing brings it to new highs, which reinforces the narrative even further, and we create an orgy of buying that pushes it all the way up significantly past the prior left shoulder. Then the last high is made on max margin, poor positioning, max greed, and smart money starts to realize that prices diverged way too far from the underlying momentum narrative, and it cannot possibly be supported for an extended amount of time up there. And they start selling, and that causes stop losses and people to start quickly taking their profits, and it falls back down to an area where everyone perceives it as value, where it started, the first support area, etc. So the narrative at this point is bloodied, and investors realize that greater fool theory is definitely still in play here with this, because that high failed and it went back to previous support levels. But some people still believe in the story and buy its support, and that causes prices to go up once again and equal around the shoulder of the other shoulder, the left shoulder here. But instead, this rally is sold this time because the narrative isn't as strong anymore. So we have half the people still thinking it's alive. The other people sell into it, and it starts to fall again and test the convictions of the buyers in this momentum narrative. And finally, price makes, they put in this decisive lower high as those people came in and sold this rally, and it breaks the support area. So it breaks this key psychological support area, and now all the people that participated in the emotional highs and lows of the game here and that bought into the momentum narrative now have to say, okay, it's over, scramble to take their losses or take little profits they have, and we get this huge whoosh down as a bear trend forms because the narrative's everyone's lost confidence in the narrative completely. So, instead of looking at a head and shoulders price pattern as some type of tea leaf or some randomness that shows up on a chart and tends to work out, if we attach the emotional narrative behind that pattern, it makes a much more intuitive sense, and we understand why these patterns actually play out and work. So it's a good method to establish psychological drivers behind price action patterns, and understanding the price action from an emotional perspective helps us mesh that analysis technique with fundamentals and sentiment to get a very clear picture of where things would go. So now let's pivot to support and resistance and talk about that emotional narrative. Support and resistance are one of the most popular things in technical analysis, something that we use a lot in our trading. And they're heavily criticized in the academic community. But that makes sense to us because the academic community, they're not focused on trying to define emotionally what's going on underneath the hood. And they can't look at these things qualitatively. They just use quantitative assessments of what support and resistance are. And that's why they think that it doesn't work. So support and resistance theory is based on the same emotional narrative concept that we just went over in that head and shoulders pattern. And here's a classic picture of support and resistance if you guys aren't familiar. So it's basically just, this level down here is support where price tends to stop its downward momentum. Up here is resistance where price stops its upward momentum. And then what happens is the theory is once this breaks out, we get an extended move in the direction of the breakout. So let's draw a little picture here. So a support area is where price would be trending downward, and then it tends to bounce off of it, like I just showed you guys in the last slide, bounce off of it. And then a resistance area, let's say that was a prior high, and a resistance area is where price tends to respect prior highs and bounce off of it. But it's key to understand these areas aren't magic. These areas aren't magic in the market where just this price level is preventing people from further pushing the stock below it. It's just emotional anchoring points for all market participants once they become obvious. So once these things develop, investors start to emotionally anchor the price action to these levels, and that's why they become significant. It has nothing to do with the actual level itself. So if support is breached, because that emotional anchoring is there, buyers are going to lose confidence and start to liquidate to conserve capital. They're not going to believe that they're right anymore. And that's because price is going against them and it has breached previous areas of support. If price is breaching resistance, then shorts are going to lose confidence and they're going to be forced to cover. And buyers become more confident, start to add positions, etc. And then even FOMO buyers enter and fuel the fire. So they're key emotional anchoring points that cause investors and traders to act upon. And then we got the retest and the emotional signature behind that. And the retest is a broken resistance become future support. So let's draw a few levels here. So if price is trending down and breaks this support line and then maybe bounces off another support, we tend to see this concept where price is resisted as it goes back into prior broken support. And the same thing is true of resistance. So if we have a resistance level and price shoots and breaks out, when it comes back down, we tend to see this resistance level act as a area of support before it continues its next leg up. And here's a few examples in the market. So, and this is very, very common. And you can see this, for instance, silver futures. Here was a support level that broke up and then we retested it and ripped up again. Same thing in, these are E-mini futures. You can see we broke a big support level right before 08 and it came up and retested that same area again and then fell. And then another one in Apple here where we broke a triple top and had a downtrend, came all the way back up and retested that prior support level. So why are these things constantly retested. It comes back to the emotional anchoring point concept. So when price breaks resistance to the upside, it becomes immediate emotional anchoring point for future action at that level. So buyers who missed out look at that prior reference as an area to buy a pullback, and shorts who are wrong will reference that area to cover some of their incorrect positions. So when a resistance level breaks, bulls are in control, and this emotional anchoring point is used to, again, be as a sort of a test of how dominant the bulls are. And if the bulls are going to continue the run, then they're going to buy this up, and shorts are going to cover in this area if they think that the narrative has been weakened on their end, which will, again, force this to go up. So the same thing happens on a support break. When we get that breakdown, underwater bulls are trying to sell out on any type of relief rally that comes after the initial breakdown, hoping to get a better price, and shorts are becoming more confident in their theme and adding to their positions. So after we have that breakdown, buyers, maybe they are in denial about the loss, but as price creeps back, they can kind of get that emotional relief of selling for a break even, assuming they were accumulating down in this support area. And then shorts become more confident in their narrative, and so they start to get more aggressive and sell into rallies. Now, candles have the same type of emotional narrative behind them as well. And we look at a few key candles here for us that really show very strong emotions in the market. And those are the dojis, full body, and key reversal candles. So a doji looks like this, and it is an indifference candle. And it happens when the market opens. It maybe goes up, it goes down, but it closes back where it started. And so this signals indifference in the market. And bulls and bears they can't decide on where to push price, and there's no dominant narrative. And so it means to stay out. There's no directional bias going on in that market at that time. As you can see in crude oil futures here, we had a few dojis before the breakdown. These are signaling to stay out because there's no conviction on either side of the market. And then when a full body candle occurred, that's a much stronger signal that, hey, there's one narrative, there's one side that's in control. And so full body candles, the extreme conviction candle, which happens when price opens and then trends in a straight direction and closes, or in the case of a bearish candle, trends straight down, is a classic example of a one-sided emotional move that is supported by either fear or greed. So in this example, we can see ES futures. There was strong conviction by the bears, and bulls are generally scared here, and they're liquidating, and we see that they closed all the way at the lows below prior support. So bulls were extremely scared that their narrative was breaking down, and shorts were getting aggressive, and sure enough, that led to a high conviction move for much further downside. Now, hammer candles are reversal candles, and what a hammer candle represents is a market that opened up, it had a very panic sell, and then immediately reversed and closed higher than where it began. So this means that the sellers are exhausted and weak hands have been shaking out, and then stronger hands are willing to step in at a perceived area of value and drastically push prices higher. So we see these typically when short-term leverage gets squeezed out of a longer-term trend. You can see there's a hammer candle here, another hammer candle here, and that's because the short-term guys are selling due to fear, capitulation, and protecting their bankroll, and then longer-term guys come in at what they feel are discount prices to the current bullish emotional narrative and bid prices back up again. The shooting star is the opposite of the hammer candle. It signals a blow off top or a buying climax, and that's where price opens and then it rips up higher, and then the narrative completely fails and we close lower on the day. So this signals that max greed was reached, that we had that buying panic. It's just the opposite of a selling panic. And you can see an example here in the bond market where during stress early in 2016, bond buyers were reaching for safety as fast as they possibly could and bid it up to completely unsustainable levels, and then it sold back off again. So panic buyers got caught up at the top, and smart money and longer term players thought, hey, this is an area where bond prices are not justified given what we feel like is going on in the market, and so they sell it back down, and it's an indication that the bull narrative is over. And you can see how it played out here. We had congestion area and we went sideways. So this definitely was a great signal that portrayed that the end of the bullish narrative had occurred. So at the end of the day, Try to view the charts and view the price action as a series of emotions, and it'll give you a much better intuitive understanding of what's going on. So when price is moving, remember, someone on one side's winning. They're going home happy. They're going home, maybe they were able to raise more money for their fund. They're getting a bonus driving a car, and those emotions play into what happens in the market down the line. The guy who's losing, he's depressed, he's worn out, he's frustrated, and he's going home, and then that type of emotion is going to have an impact on how he decides to buy and sell in the future. So it's key to think about these things, and it also puts the game into a perspective of more like poker, where it's more of us versus the participants, and we're able to get a better understanding of what's going on from that perspective. So buys and sells in the market are not purely rational. People need to protect their bankroll. They need to protect their emotional capital. They need to keep investors happy. And there's many other buys and sells that are going on that have even nothing to do with the fundamentals. So if we can attach this psychological component to price action, we'll get a better insight into why people might be buying or selling when it has nothing to do with the underlying fundamental picture. And that in turn will help us be able to better identify inefficiencies. And that's why this qualitative interpretation is so important, that you can never get with the quantitative one. Is you can never tell when an emotional efficiency occurs if you don't define the emotions behind the moves. So next time you look at a chart, try to think of it in this fashion. When we have a huge run-up, that's euphoria. Think of the feelings that people are feeling, in this case, Cisco stock back in 99. How is that changing their lifestyle? How is that changing their beliefs and systems going forward and their buying decisions? And then when we see a huge fall, that's true panic. How is that going to make people that have been in this stock act in the future? What are they going to do? How are they going to act down the line when we see another run-up? Are they going to not participate because they've been burned out? And then when you see long consolidation patterns, you want to be thinking about frustration, how bulls and bears haven't made money in a long time. It's been a dead money asset. So how is that going to make investors feel if this thing finally breaks out or breaks down? So if you're in tune with the emotions of the market and the emotions driving the price action, the whole thing's going to seem a lot more intuitive to you and not as abstract as simply prices and bars breaking below certain levels on a chart.